Good afternoon. My name is David Fine, the CEO of ValuSource. I'd like to welcome you to the Top Mistakes to Avoid in Valuations webinar. I'd like to introduce Howard Lewis, who's presenting our webinar today. I think he's the perfect person to present this webinar because he's seen the valuation world from so many perspectives over 35 years. As the former national program manager at the IRS, Howard oversaw over 300 valuation engineers performing thousands of valuations. And he was the executive director of the Institute of Business Appraisers for many years. And now he has his own consulting company that helps valuation professionals that face tough valuation challenges with the IRS. And before we begin, there's a few housekeeping items. If you have questions, please type them into the question window in the GoToWebinar control panel on your screen, and we will answer them at the end of the webinar. The webinar will go for an hour, but we will be happy to stick around until all of your questions are answered. So with that, I'll turn it over to you, Howard.
Thank you very much, David. Welcome to everyone. We have a very nice turnout today, and we're very pleased to welcome you to this very special event. The theme is top mistakes to avoid in valuations. I tend to turn that around into the things that we should do to present our engagement results in the most positive light, whether we are writing appraisal reports, testifying in court, presenting information to clients or even adversaries. The basis for this presentation is two articles that were written and recently published by Timothy Lee and Paul Hood. And we'll be making copies of those articles or links to the website where they reside available to each of you after the webinar. Thank you very much to David Fine and ValuSource for sponsoring this webinar. Just a very brief couple of things about myself. As David mentioned, I spent my career, or the first part of my career, at the Internal Revenue Service. At present, I'm the managing director of a very small consulting firm. We provide services generally to taxpayers who are troubled by IRS actions and need intervention. I'm presently the executive director also of the International Society of Business Appraisers, and please feel free to call me for guidance and assistance at any time. I'd like to take just a moment to talk to you about my view of the valuation world. It's taken quite a number of years to put this together, and as you can see, there's many dimensions to what I call the valuation world, and we appraisers and professionals, we really need to understand not only each and every one of these inputs and elements, but also how they react and relate to each other. Obviously, I'll mention a few of these very briefly. We can go around clockwise, and we're all bound to adhere to the standards of the associations and the professional practices that constitute our body of knowledge. We constantly have to keep budget in mind. We want to provide the best possible services to our clients, but they have to be affordable. Our ethics and standards are givens. They're paramount. They're number one, and they guide us in our practice. Education is the basis for our knowledge, skill, and ability. It becomes our experience, and it enables us to interact with clients. We do have to deal with issues such as document management, managing our practice. All of that takes place in the realm of risk. We need tools and data to support all of our activities, and we have to be aware of not only the environment, but the quality of our work, and especially laws and regulations that govern how we practice, actually how we must practice. And that's the premise for a lot of what we're going to talk about today. So I'll be talking about these concepts that were developed by Messrs. Hood and Lee. And let me talk to you about maybe about a half a dozen of them. First, replicability and the relationship between replicability and the concept of credibility. Credibility is what we have to sell. We sell our knowledge and skill. We apply our experience. We produce work product for our clients, but they're only valuable, and our practice only grows if we are credible. So what is credibility? Well, credibility consists of quite a number of different elements. reliability, relevance, sufficiency. We're going to talk about some of those things today. And first, we'll talk about replicability. Replicability is the element of credibility that tells us that when we present our work product to clients, stakeholders, judges, juries, administrators, others, then they need to see, those who are looking at our work, those who may be reviewing our work, they need to be able to replicate our work to assure that our work is credible. Our own association standards require that we provide sufficient details and explanations and rationale so that the reader of our reports, the reviewer, the evaluator of our conclusions and opinions, can in fact say that they are able to and that they can replicate our work product. Being correct is just not enough, and the tax court has said that numerous times. The True Estate, which was a 2001 tax court memorandum decision, addressed this issue. More recently, the Gallagher case addressed the issue, and in the Gallagher versus Commissioner tax court case, we find that two appraisers, one for the government and one for the estate, for the taxpayer, in many respects were no doubt correct in terms of their conclusions and work product, but the court didn't accept their correct conclusions because of certain failings contained in their testimony or appraisal. Our qualifications will only go so far, and the essential elements to ensure replicable work product are the following. First, that we translate our thought processes, our work process, in telling a story into either our testimony or written report, that we translate those things so that the reader can follow them, appreciate them, understand them. In providing a full discussion of our work process, wherever we make assumptions, where we state conclusions, where we present data and facts, where we decide on approaches and methods, we need to provide complete explanations so that we can guide the reader as to how our conclusions are reached. Let's look at an example as to how exactly we do that. The issue is replicability ensures credibility. How do we do that? Well, here's one way that you can do that in every one of your reports. Describe your methods in telling the story of your work process in an order, in an orderly fashion, in a chronological order, for example. And here's one way to do it. We would write first, and here the issue is, how did I approach the market data method in valuing a particular subject interest? Well, first I identified the SIC code that was applicable to our subject company and marketplace. Next, I researched market data using the IBA database, for example. Then I found 40 appropriate data points, and finally I arranged these in 4 equal quartiles, sorted, stratified, arranged by revenues, and Table 1 shows these steps and the results of this analysis. So you would state exactly what you did, you would then show what you did in a table or the body of the report or in some other way, and in that process our work is presented in a replicable fashion. Let's look at the next element. Beware of case law. Beware of case law. Now, this error used to be made much more often, in my view, than perhaps at current. But I still see reports that contain case law in support of valuation conclusions. That's generally and almost totally a prohibited practice. Discounts, for example, and that's where case law is very often supported or used to support a quantitative result or indication. Discounts such as marketability discounts, control discounts, liquidity discounts, blockage discounts, they're factual issues. They can be approached technically in two different ways, an implicit approach or a direct approach, but case law is replete with analyses, conclusions, and authorities, and we have to avoid relying certainly purely, as Hood and Lee say, or even largely, and maybe totally, on including any reference to case law in our reports. The Berg Estate versus Commissioner, an interesting case that many people believe was one of the origins of business valuation body of knowledge, said the following: several cases which approve discounts that are approximately equal to those claimed is irrelevant. 1991 Tax Court Memorandum Decision. So beware of using case law in your appraisal reports. The next example that I'd like to discuss, well, here's an example of beware of case law. How would we present our analyses without using case law in an environment where case law is actually important? So here's how I would do it. My report would state language to the effect of the following. Case law supports the use of restricted stock studies as one approach to developing a discount for lack of marketability. I would mention that I know that, and I would point out that there is authority for using certain studies, whether they are these restricted stock studies or others, as one approach, not the approach. So here we're telling the reader that we do understand the environment, we understand the rules, we understand the law, we're familiar with the case law, but then I'd continue. I researched recent journal articles and other generally accepted sources in the business valuation body of knowledge. And I probably would refer to the very ones that I researched, perhaps in footnotes, perhaps in a reference to a listing in an appendix, perhaps in a chart or table within the report. I would then continue. The IRS has published a position paper reviewing many common DLOM models. I chose to use the Longstaff model to estimate the discount in the subject case. Of course, this is just an example. You may choose to use the Longstaff model or another model, or other models, plural. My reasons for using the Longstaff model in this appraisal are, and now I would state the reasons why the Longstaff model is the most relevant to my subject case. Then, I tested the reasonableness of the discount for lack of marketability by applying to, maybe a different number, other independent models. I would state which ones. The results correlated to within 10%. Table 2 shows the results of this analysis. You can see that I have mentioned that I'm aware of the place of case law. I have directed the reader, the evaluator, the reviewer, the judge, to exactly what I did. I spelled out my process, I told the story, I explained everything, and I illustrated the results. The next topic deals with sufficiency, and the pointer here is ensure sufficiency of information. Ensure that your development process and your report demonstrate that you recognized, gathered, evaluated, analyzed, and reported on a sufficient amount of information. That doesn't mean the maximum amount of information, but it certainly means that we want to make sure that the reader, the evaluator, the reviewer knows that we covered all the required bases. And what we want to make sure we avoid at all costs, and I've seen this happen, is we want to avoid a situation where the opposing party finds information that is relevant to the case, detrimental to our conclusion, that we did not find. And so how do we make sure that we are sufficient in our presentation? By thoroughly exploring comparables, whether in the guideline public company method or another method under the market approach, that we research adequately, news reports, published articles, prior transactions, and professional analyses of the marketplace, maybe even the subject company. A 1998 tax court memorandum decision in Barnes versus Commissioner teaches us this very lesson. Well, what kind of language might we use in our report to enable the reader to conclude that we have addressed a sufficiency of information in our work process? Well, here's what I might say. In order to assure my research and data were complete, I conducted searches on the following research databases. Those might be National Economic Report from KBD. They might be First Research, IBIS World, you know the various sources. And you would mention, state, identify which ones you use, how you use them. I made appropriate inquiries with present and former corporate management, something that we often overlook. It may be more difficult, certainly would be more difficult, but certainly something we should consider. In our management interview, I would not limit our interviews to inquiries with present management. I'd consider talking to former corporate operations and other management as well. You can learn a lot. And I compared my research findings from those sources with data obtained from other sources. And you would spell out, the 3 dots means that you need to complete the sentence. Perhaps this turns into a couple of 3 sentences or a short paragraph. And then the reader is going to be positively looking at your presentation, and we'll be able to conclude to a reasonable extent that we've considered, found, and presented a sufficiency of information. The next subject is, and the prescription is, explain everything. And I've made the caption here merely these 2 words, and both of these words are critical. First, explain. Gallagher teaches us all the lessons we need to with the concept of explaining and the perils of not explaining. And everything means everything. If there's something significant that we don't explain in our report, we're going to leave it to the other side, which may be the judge. And in the tax court, we've found judges, and what occurs when they're not satisfied that they have received a sufficient amount of explanation, and our presentation is imperiled. Explain everything. Now, what does that mean? Well, in general, it means our discussions, narrative, presentation must be significant. It must be thorough. There must be substance to it. The reader must be able to follow it. It must contain rationale and reasons for what we did, why we did it, how we did it, how we used it, and how it is to be understood. In fact, one way to check your own work product here is to ask yourselves the famous 5 W's and add an H to that checklist. The 5 W's and an H: who, what, when, where, why, and how. Who are you talking about? Who did you, and what did you research? When did you do your work? When did the events occur? Who, what, when, where? Where did all these things take place? How did you approach your work product? Why did you do what you did? A famous, magnificent illustration of this is Roger Grabowski's report in Kohler versus Commissioner. Kohler versus Commissioner, U.S. Tax Court case, decision rendered in 2008. A number of very famous appraisers were involved in that case, and Mr. Grabowski's report, having been filed with the court, and has been compiled and available so that you can actually read it, that I call a magnificent example of explanation. If you look through the 94 pages of Mr. Grabowski's report in Kohler, you will find constant, continual answers to the questions of who, what, when, where, why, and how. Explain everything with a significant discussion. If we're talking about weightings of methods, weightings of indications of value, weightings of the use of different approaches, explain those weightings thoroughly. In the reconciliation process, explain what the process was, not just the weights or percentages that you applied, but explain how you came to conclude thusly. Always focus on the relevance, which is another critical element of credibility. And in your discussions, where you're explaining everything and providing the rationale for your process, make sure that you point out, in addition to the who, what, when, where, and why, but the relevance of all those things to the purpose for which you took those steps. The methods that you used, the assumptions that you made. And if we look at the true estate again, we'll find what the tax court said in the area of explanation and rationale. Here's what the tax court said. The appraiser did not explain the relative weight placed on each factor. The judge also said, and this is worse, we cannot rely on his report's valuation conclusions. That's the conclusion of the court that we want to avoid. We want the court to rely on our conclusions. How? By explaining everything. Here's an example that you can take away with you. Not necessarily going to read some of these longer paragraphs, but in this one, I told the story. In applying the market approach, I used the guideline publicly traded company method. So I said what and how. Application of this method required the use of, and then I spelled out the sources of information that I researched in order to apply this method. I mentioned the applicability of the comparable companies to the subject's business groups. That's relevance. And I concluded by saying these factors led me to consider the value indicated by that method for support purposes only and not as a directly applied methodology, but I include that significant, clear discussion in my report, and then I used that method within the market approach as support, as a test of reasonableness, as a sanity check. Something is very important to the reader concluding that our work is credible. The next subject is ensure the completeness of guideline public company or subject company transaction analyses. Back to the true estate again. That case pops up a number of times, and it's worth reading to see the details and specifics of what these concepts are all about and how the court addressed some of these issues. So how do we ensure the completeness of these methods within the market approach? Well, as the true estate tells us, first of all, we have to identify, and some of you may be wondering, do you really mean that some appraisers don't identify the specific guideline public companies in using that approach, or that method in the market approach? Well, afraid so, yes. Identify all the guideline public companies with a sufficient amount of information about them so that the reader can conclude that the use of those companies is relevant. Tell the story, explain everything, provide a sufficient amount of information, be complete about that whole process? Well, all these, many of these individual precepts work together. They work with each other. Completeness is not separate from sufficiency. Relevance is not separate from replicability, as you can see. Clearly show the measures of earnings used in applying this method. Explain the market sources, whether they're SIC or NEICS codes. Explain the codes. Explain how you know that the subject company is properly placed in that market. Explain all of your computations. To some extent in the narrative of the report, to another extent in footnotes included within the report, to a third extent in references to appendices or exhibits or attachments if you need a lengthier explanation. Great example of that, Grabowski's report in Kohler. That case involved a 15% rounded estate interest in the Kohler company. The 15% interest was valued by Mr. Grabowski and accepted by the court at $65 million. You can tell the potential value of the entire company. And that report was 94 pages long. 14 pages of it was the DLOM narrative. Excellent, best I've ever seen. 9 pages was the introduction. And so you can see the body of the report, excluding the DLOM presentation and the introduction itself, was a fairly modest-sized report for a company 15% of which was valued at $65 million. In addition to the 94-page report, Mr. Grabowski refers to 3 other volumes and extensive appendices, exhibits, attachments, and references. So you can see just how you can structure the report so that you can be complete, at the same time be concise within your report, that your report is optimally readable, and yet all of the information that the reader, evaluator, will need can be accessed upon need. Now, what did the appraiser do here? Well, he provided no data showing how he computed multiples, which multiples he applied, or how he weighted these things. And the court concluded we cannot evaluate the reliability of his results. Why? Because he provided no data, how he computed, which multiples he applied, or how he weighted these things, and we cannot evaluate the reliability of his results because we can't replicate his work. We can't conclude that we have the credibility that we need because we can't follow what the appraiser did because it was incomplete. Probably not sufficient, certainly not replicable, and was lacking in relevance. You can see how these things tie together. Well, how can we ensure completeness of the presentation of the guideline public company method in the market approach or subject company transaction analysis? Well, I'll give you another example here that I extracted, and you can read it yourself when you have a little bit more time. But again, I'll just point out here that I continue to tell the story in the first person. I then reconciled my conclusion, I and my. I considered 2 types of prior subject transactions. I determined that both represented valid data. However, due to certain circumstances, some of the data was not reflective, not relevant to valuation date market conditions. And at the end of this paragraph, my conclusions also reconcile with the appropriately adjusted share price reported for the prior stock sales. Completeness of the story of the guideline public company market method, these methods under the market approach. Let's see, I think we have a question, and I'll just hold the question until we get towards the end of the presentation. But as a reminder, please feel free to upload any questions or comments that you have, and we will be covering them at the end of my portion of the presentation here. All right. The next subject I'd like to discuss is how to maintain and demonstrate independence. This is an important element to credibility. It is a standard in every one of the association standards. It's an ethical provision that is unequivocal with respect to how it covers and governs all of our work. But it's not always quite so simple. In my testimony before the tax court in Health Trust, the HCA, and it goes back quite a number of years, the opposing expert, or the expert for the taxpayer in that particular case, served as the expert witness, rebuttal witness actually for the government. If you'd like to be bored, you can read that reported decision of the U.S. Tax Court, Judge Wells, HCA v. Health Trust. And in that particular case, the expert for the company, the taxpayer, was an analyst from Salomon Brothers on Wall Street. Interestingly enough, his appraisal was not an appraisal, as we know appraisal. It would not be recognized today as a qualified appraisal under the income tax regulations. It would not. I know. I wrote those regs. But it was accepted by the court as evidence of value, although the value conclusion was not accepted by the court, in part due to my rebuttal testimony. Now, the individual for Salomon Brothers had a personal investment and an equity interest in the company that he was appraising. Now, it was a very large company. The issue involved in the case involved certain debentures. I think they were preferred stock or debentures, that the value of which at issue was in the neighborhood of $100 million. And those were just those the debentures themselves. Well, the expert for the taxpayer had a personal investment in the company. It turned out to be $15,000. It was considered by the court to be not relevant to that appraiser's independence. But it came up in court, and the judge had to make a decision. So we have to be aware of these things all the time. Independence is demonstrated by assuring that we have no personal interest, or if there is one, it's clearly disclosed. It's discussed up front, certainly with the client. It's included in engagement letter proposals, and it's made very clear. But that we have no personal interest in the subject company, certainly not in the outcome of the litigation. These things must be certified. We also ensure demonstration of independence by reviewing our own report and looking for instances of bias or perceptions of bias. And they're two different things. Bias is clear. Perceptions of bias is possible indications or indications of possible bias. And those things arise by using subjective words, words that may be personal with respect to an adversary, or in many, many other ways. And you can find references to how to look at, how to review your own report in the body of knowledge about report review. Examples of lack of independence include issues dealing with relationship, individuals who had a senior position with a company or an affiliate, an individual, an appraiser, who had a significant investment in the company. Of course, the question of what is significant may come up, and in the case of HCA v. Health Trust, it did come up. Further information from the Cook Estate versus Commissioner, 86-2 is the reference. In order to maintain and demonstrate independence, we want to do the following things, and then translate them into specific language. Review the requirements of your association standards, other association standards, and ethics provisions, and make sure, as I mentioned, that you address appropriately these issues to the extent that you need to in engagement letters, the report itself, certainly assumptions and limiting conditions, and the representation letter, which I believe still today more than 50% of appraisers never use. Strongly suggest that you do use representation letters in your appraisal practice. We have a few questions coming in. That's very good, and we will get to them. Thank you for elevating them. The next issue deals with properly classifying the subject company in the marketplace. And examples of failure to do this in the Bennett Estate, 1993 Tax Court Memorandum Decision, dealt with the classification of that particular company as either a real estate management company or an investment or holding company. And everything about the appraisal process and practice, of course, hinges upon the proper classification of the subject. What did the court have to say? In his report, the valuator should have characterized Fairlawn, the company, as being engaged in commercial real estate management rather than as an investment or holding company. Well, here's some language that we might consider, you might consider in addressing this issue. After identifying and selecting the guideline publicly traded companies, their business and financial profiles were analyzed, and you can talk about how you analyze them, how, the H of who, what, when, why, where, and how. Once these differences and similarities were determined, appropriate adjustments made, multiples calculated, applied to the subject's stabilized operating results to estimate the fair market value of the equity of the business. So you explain the relationship between classification, your developmental process, and the conclusions that you reached. And once you explain by stating what you did, you then illustrate what you did. Explain first, illustrate immediately. Be consistent. How can we be consistent? Well, certainly by avoiding contradictions. And as a reviewer, one of the most common things that comes up are contradictions, not only within a report, but there are things we need to be careful of. Certainly, we don't want to contradict ourselves within the report. We don't want to contradict ourselves with respect to the measure of earnings and the discount rate that's applied. That's a famous one. But we have to be careful about avoiding contradicting ourselves by reference that others can these days rather easily find regarding prior work product, perhaps testimony in court, things that are on the public record, articles or speeches, presentations or writings, books that we've written. We have to be really careful about these things. And assumptions, technically speaking, must be consistent throughout all of the methods and approaches and in many different dimensions. The rates of return and how they stack up against measures and indications of earning. When we look at the levels of value chart and compare that to the standard of value and the premise of value, we have to check ourselves and make sure that we're consistent throughout, or we find ourselves in a situation such as the appraiser did in Moore v. Commissioner in 1991. You can see what happened in that case. How to represent consistency: use footnotes so that you can reference from section to section within a report, from the research that you applied to methods that you used, to how they relate to the approaches that you considered and which ones you selected, and how all of that pertains to the entire work process. Now, I strongly suggest footnotes as opposed to endnotes. Footnotes should appear, in my view, on the same page that they refer to, as opposed to at the end or some other place in the report that someone needs to continually turn to and turn back from. Relevance is another element of credibility. We want to test ourselves and test the extent that we have succeeded with demonstrating relevance throughout our report. I mentioned some of these issues in the prior slide, that the consistency between rates of return, income measures, levels, premise, and standards of value, all of that addresses relevance as well. The premise, the standard, and the level of value in our calculations must be consistent as methods considered, selected, rejected, and approaches. Also, the research that we use, the studies, the reports that we refer to, things that we've written, how others have addressed these available informations, and how we apply our analyses to the conclusions. And in the Kraft v. Commissioner case, we read that the data used by the evaluator cannot reasonably be construed to represent conditions in milk markets and the failure to include data from the larger dairies is significant. It's an issue of relevance. An example you can read here: in concluding on the appropriate required rate of return, I considered each methodology to be relevant methodologies to indicate rates of return for Kohler as of the valuation data. I took this paragraph from the Kohler case, and you can read more at your own leisure. Do not cherry pick valuation multiples. That's a no-brainer, again, but we have to make sure that we, A, don't bias our work process in this way, and equally important that we don't leave the impression or the possible perception that we did. Avoid all real bias and possible perceptions of bias. Wall v. Commissioner, sorry, the appraiser didn't do a good job here. He did not use all the guideline company multiples, but instead picked and chose among the lowest. Well, you know, maybe he didn't, but the court thought he did. How do we represent that we didn't? To ensure the objectivity of the selection of market comparables, I carefully considered, stratified all, tested variability, examined all data, and then add whatever else you did, so that it's very clear to the reader and the evaluator what you did and why, and that what you did was objective. Exercise required due diligence. There's a lot of standards, many standards that we have to adhere to. From 5960 on through all the other body of knowledge and indications of the work process that we have to follow. The Bennett estate gives a very good example of the failure to exercise due diligence. And due diligence means that we cover all the 8 elements of 5960, that we make sure that we've acknowledged, researched, and understand and evaluated prior transactions, possible IPOs, offers to purchase. Consider the need for a representation letter to be comfortable that you, in fact, have covered all the bases and that your client is representing that you did and that the client complied with your requests that were for that purpose. Make sure that you identify, tell the whole story. Judge Laro used to say, tell the good, the bad, and the ugly. Identify difficulties, obstacles, and problems that you encountered. Explain what you did about them. Make sure that you cover the hypothetical buyer and the seller in all of your analyses. And an example I leave with you here, which again is first person, tell the story. In performing my analysis, I worked with a team of professionals I used and relied on, as is customary in the profession, and I've accepted the accounting data, information, and other descriptive information is provided from authoritative sources. If your firm allows you to use the first person, I strongly suggest you do so. If your firm has a policy that does not permit that, I would suggest talking to your firm about their policy. Or following them, obviously, if that's the response that you get. In a very particular issue, carefully consider the age of comparables. In the Hagerman estate v. U.S., the appraiser relied particularly on sale 2. Unfortunately, the sale price was 20 years outdated. Clearly, the evaluator's valuation is seriously flawed. We don't want our report to be subject to that kind of criticism. And with that, I've actually covered about half of the Hood and Lee elements. You can take a look at the 2 articles. We'll send the references to you so that you can see more about each of these and some that were not covered in today's presentation. And let me see, in the few minutes remaining here, what questions have been asked and what I can say about them. Question number 1. The IRS Practice 8 appears to discourage the use of IPO studies for DLOM. Is this correct? As to restricted stock studies, do you believe the older restricted studies by themselves, despite their age, are sufficient to substantiate a DLOM? Let me answer the second question first. Do I consider the older studies by themselves, despite their age, haven't you answered your own question almost? My answer is no. They're not sufficient. Not necessarily because they're older, although that is a problem, but the question says by themselves. It is not a good practice to use one type of study by itself as the indication of DLOM discount or any other indication of value or discount or element in your report. As to the IRS practice aid and its discouragement of the use of IPO studies, the IRS practice aid discourages a lot of things. I think they even discourage long staff because they found that in an extreme case, long staff model breaks down at the 0% and 100% ranges. But to me, that's irrelevant. They frankly didn't do a thorough job, and the fact that it might break down at the extremes doesn't mean that it's not valid in other respects. So yes, it appears to discourage the use of IPO studies for the discount. That is correct. It doesn't mean that it's inconceivable to use them, and you've got to be very careful about how you use the IRS study, but also you should definitely be familiar with it. The next question, Grabowski worked for a very large firm. He sure did, Standard & Poor's, with great support staff. How, from a budgetary standpoint, does a sole practitioner perform such a time-consuming valuation? This is coming from a former IRS CID appraiser. Well, I'm not sure what CID is other than Criminal Investigation Division, which I didn't know they had appraisers, but whatever that means, the question is a good one, and I do have an answer for that. Yes, he worked with a large firm, and that was a very large, significant, and very contentious matter that he represented the client for. But the fact that he was able to write his report in 94 pages tells us, and I think can tell you, that you can do the same on a smaller scale because of the budget limitations that you might face in your particular subject case, but you can adopt the best practices of what he did with the firm and the staff and how he presented it. Now, the question also says, how does a sole practitioner perform such a time-consuming valuation? Well, it depends on a lot of things, as I just mentioned, but if you do have a larger valuation, then you should be able to have a larger budget, and you can certainly even adopt some of the more time-consuming elements here, or bring others involved that can help you. And if you want to get in touch with me privately, I'd love to know what a former IRS CID appraiser means. Question number 3, how do we get the Grabowski report that you referenced? I may let David Fine address that. He's going to have some concluding remarks here, or we can answer that question since it's a link that's complicated to describe, and I'll ask David to let you know in the appropriate way after the webinar. Please repeat and spell the name of the case. That's easy. It's Kohler versus Commissioner, K-O-H-L-E-R v. Commissioner, Kohler v. Commissioner. I'd like to turn it over to David in just 30 seconds or so, but I've known David for quite a number of years, and I've known the ValuSource and how it helps the business appraiser coordinate all these very complicated things. And what I've listed here are just a few bullet points so that I could address the technical issues that I mentioned with many of the ways in which ValuSource helps. ValuSource provides research tools, and that enables you to be consistent with accepted practices. It enables you to be more thorough with your analyses, and that helps you provide greater, more sufficient explanations. The sources of information address issues of compliance, and the tools and support from the company enables you to be consistent and complete, which are 2 or even 3 of the subject areas that I mentioned. So that's today's presentation. I thank you very much for paying attention to me, and I'd like to turn it over now to the CEO of ValuSource, David Fine. Thank you.
Thank you, Howard. I want to spend just a few minutes talking about how ValuSource addresses these areas that Howard discussed today. And I think to understand ValuSource and our products and our approach, you really need to understand our mission, which has been my personal mission in life for the past 28 years. Our mission in life is to help you provide simply the best and most accurate valuation possible. in the least amount of time. So why does ValueSource sponsor webinars like this? Well, it's because the content presented today not only provides valuable best practice strategies, but also really highlights how ValueSource data and software can help you provide better valuations faster. The areas that Howard covered today, including replicability, sufficiency of information, explain everything, ensure completeness, consistency, relevance, due diligence, are issues that ValueSource has been using as the lens for the last 28 years to build data in software products. So how does ValueSource help? Well, we help in two broad areas. One is data, the other software, and I'm excited to announce after years pulling it all together the release of BV Data World, a new way to purchase valuation data. BV Data World includes 20 databases available in 5 subscription levels that save you anywhere from 50 to 80%. And we also make the databases available a la carte if you don't want to purchase a level. And the other area is software, which automates and standardizes the entire process of doing evaluation, from data input, data integration, comprehensive analysis, through standards-based report generation. And as I said, BV Data World provides 20 databases in 5 subscription levels, but it's much more than just simply data. We've spent years developing an intelligent web-based delivery platform that helps you understand, analyze, and get your arms around and apply the data. I don't have anywhere near the time to talk about 20 of our databases, but I did want to highlight a few that show you how ValueSource thinks about these kind of things. For example, guideline public company data. The data comes from Morningstar's fundamental data set, but it's about more than just good public company data. Our product has an Excel-based analyzer in it that the data downloads into, which analyzes the data and helps with the decision process of determining which companies may be considered comparable. RMA Valuation Edition is one of my favorite examples of how ValueSource looks at the world. We worked with RMA to develop the Valuation Edition of the annual statement studies, and it has 10 times more data in it than the regular edition. So now, for the first time, for every item in the common size income statement and balance sheet and ratio data, you can determine a company's rank in the industry rather than just simply comparing against the median, which provides a much more precise way to benchmark financial performance and adds credibility to your reports. For example, saying gross profit, saying that for the gross profit, my subject company is ranked at the 83rd percentile is much more precise and explainable than saying my subject company was 10% above the industry average. The RMA Valuation Edition is the only financial benchmarking data in the industry that provides this powerful ability to do ranking. And if you do financial statement benchmarking, which I'm sure many or most of you do, you've got to at least take a look at RMA Valuation Edition. Plurus, one of our more recent additions, on top of the more than 3,000 restricted stock transactions in the database, we added an analyzer which allows you to get your arms around and understand both the RSED, or the restricted stock equity discount, as well as the PEVI, or the private equity discount increment. Let me just mention the Duff & Phelps cost of capital calculator. We worked with Jim Harrington at Duff & Phelps to streamline the process of generating a cost of equity report from risk premium data, and I think we did a great job of it. We simplified the input, the output, making it more intelligent, and I believe much more useful. Here's another unique one around the valuation world. There's an incredible amount of information coming out every month about business valuation. So how do you guys keep up with articles, webinars, conferences, newsletters? It's really tough. So Around the Valuation World is designed to provide the most relevant and compelling valuation information in a Cliff Notes style 90-minute webinar. And all the past Around the Valuation World webinars are archived, so you always have easy access for them. So here's one of my favorite ones, Valuation Software. Our software is done in Excel and Word, and many people, and I'm sure many of you on this call today, think that you simply can't perform a professional quality valuation using software. But instead of me trying to convince you that our software is even worth considering, I'm going to let Daryl Durrell do that for me. Daryl's a CPA, MBA, ABV, ASA, and CVA. He's a longtime customer, and he recently wrote an article in Jim Hitchner's Financial Valuation Litigation Expert Journal that I'm going to send you a copy of. And whether you ever use our software or not, the article brings up a number of great issues that you really need to understand, consider, and address in relationship to building complex Excel models to do valuations. So, next steps with ValueSource. If you've not seen our databases or software in a while, I encourage you to take a look. It's all been updated and it's completely revised over the last couple of years. And if what ValueSource does intrigues you at all, I'd like to talk to you about how we can help you improve your valuation process. We provide both demos and no-charge trials so you can see for yourself if we can help you perform better valuations faster. Give me 15 minutes on the phone and you'll know whether ValuSource can help you or not. So I'd like to thank you for spending time with us today, and our contact information is on the slide if you want to talk to Howard about this webinar or his other services and consulting. And after the webinar, we will be sending all of you the slides to the webinar as well as the original article, Top Mistakes, that was done by T. Lee and L.P. Hood. So thank you again for attending, and if you have any questions for either one of us, we'd be happy to answer them. If you have any questions now, that you can put them in there. And someone just put in a question that it says it's Dave Miles, but the name on the slide is me. My name is David Fine. We just happened to log in with Dave Miles, organizer's name. So that concludes the webinar. And if you have any other questions, type them in and we'll answer them. Otherwise, have a good afternoon.